Ladies and gentlemen, good day and welcome to the Q1 FY2024 conference call of Centum Electronics Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anuj Sonpal from Valorem Advisors. Thank you, and over to you, Mr. Sonpal.
Thank you, Michelle. Good afternoon, everyone, and a very warm welcome to you all. My name is Anuj Sonpal from Valorem Advisors. We represent the investor relations of Centum Electronics Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the first quarter of financial year 2024. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Let me now introduce you to the management participating with us in today's earnings call and hand it over to them for opening remarks. We firstly have with us Mr. Nikhil Mallavarapu, Executive Director, Mr. K.S. Desikan, Chief Financial Officer. Without any further delay, I request Mr. Nikhil to start with his opening remarks. Thank you, and over to you, Nikhil.
Thank you, Anuj, and good afternoon, everyone. I'd like to extend a warm welcome to all of you for our first earnings call. Thank you all for your interest in Centum and for making the time to join the call today. Despite being listed for close to 30 years, this is our first earnings call, and I believe it is reflective of the heightened interest in our company and the ESDM sector more generally, which is at a turning point with all the global and domestic tailwinds which have been long awaited. Given that this is our first earnings call, in the interest of some of the people who are new to the company, let me first start by giving a brief overview of the company. Centum Electronics was founded in 1993 in Bangalore by my father, Mr. Apparao Mallavarapu. Since then, we have grown to become a full-play electronics system design and manufacturing company, catering to the high-technology segments of defense, aerospace, space, mobility, which includes railways and automotive, industrial, energy, and healthcare. The company operates under 3 verticals: electronics manufacturing services, build to specification, and engineering R&D. Under electronics manufacturing services, or EMS, Centum is responsible for pilot and mass production of electronics with designs presented by the client. It is a build to print model. Here, Centum offers a wide range of manufacturing solutions from printed circuit board assemblies to complex box builds, line replaceable units, and full system integration. Build to spec, or BTS, is a turnkey end-to-end service vertical which includes taking a project from conceptualization and designing to mass production quickly and efficiently. Operations under BTS are mainly driven by domestic defense and space. Engineering R&D, or ER&D, is a pure engineering service vertical involving conceptualizing, designing, and certifying electronic hardware, embedded software, FPGA, analog, and RF, which is managed by our French subsidiary, Centum TNS, or Adatel Group in the past. Our portfolio is well diversified in terms of revenues from the different industry segments, as well as from a service offering. We have operations in India, Europe, and North America, and our marquee customer list include the leading global OEMs and domestic organizations in the domains we operate in. Now, with regard to Q1 FY24 performance, on a consolidated basis, operational income for the first quarter was around 244 crores, which grew by about 17% year-on-year. This growth was largely driven by the increase in revenues from the EMS business unit as a result of new customer ramp-ups. On a quarter-on-quarter basis, there was a reduction in revenue primarily due to higher revenue contribution from the build-to-spec vertical in the previous quarter, which tends to be lumpy in nature. It is therefore important to view us on an annualized basis and not on quarter-on-quarter basis. The order book at the end of Q1 remained steady at 1,542 crores. Outlook for the order book for the year is looking strong with the opportunity pipeline we have. On the domestic defense and space side, the push for more indigenization as well as focus on space, an area where we have good capabilities, presents some good opportunities for us. Also, investment in railways in India and other regions is strong, and our passenger information systems business is expected to grow with new project awards. Electric mobility is another area that we've had strong traction with and are expecting good order intake from existing and new customers. Now I will request Desikan, our Chief Financial Officer, to cover the main points on financial performance.
Thank you, Nikhil, and good afternoon, everyone. Welcome to the earnings call once again. Let me give you some of the key performance highlights for the first quarter of the financial year 2024. Though Nikhil mentioned, I'll repeat this once again. On a consolidated basis, our revenues for the first quarter was about 244 crores, which is a growth of 17% year-on-year. And EBITDA reported was about 18 crores, which actually grew at 57% higher compared to the last year same time. The EBITDA margin stood at 7.33 for the first quarter. The net profit reported for the quarter is 1.4 crores. The growth in the consolidated revenue on a year-on-year basis was mainly coming from the EMS business, while the decline on Q-on-Q is attributed to the high revenue contribution from the BTS segment in Q4, which all of you must have already noticed that. And that business, as we keep saying in all our communications, is a bit lumpy in nature. So I repeat once again what Nikhil said, it may be appropriate for us to be compared more on a year-to-year basis and on a yearly basis. The EBITDA margins increased from 5% in Q1 FY23 to 7% in Q1 FY24 due to the improvement in the revenues of the EMS business. We are taking quite an amount of efforts to improve the EBITDA at the French subsidiary in the coming quarters so that our consolidated EBITDA moves to a much higher level from the present level of 7%. As Nikhil mentioned, the order book, though it remained flat at 1,540 crores, similar to March levels, the outlook is looking very strong and the opportunities are looking very bright. The working capital levels remain similar to March 23 levels, which is about 80 days. I think that's a very quick summary of the brief financial performance, but I'm also happy to inform you that Centum was a key industrial partner to ISRO for the electronics side on the prestigious Chandrayaan-3 mission, and we supplied critical modules and systems. And lastly, Centum was awarded a certificate of achievement by one of the DPSUs for indigenizing critical systems for armored vehicles. So I think that provide some kind of a highlight and some details on the Q1 performance. With this, we can now open the floor for questions and answer sessions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We will take the first question from the line of Vikram from NIA Advisors. Please go ahead.
Hello. Yeah. Hi, sir. Thanks for the opportunity. Sir, my first question was in AGM we were guiding the subsidiaries will contribute positive PAT this year. And if we check in Q1, there is negative difference of 5 crore in PBT. If I check standalone and consolidated, which means loss of 4-5 crore from subsidiaries. So, and if I see like there is also approx 9 to 10 crore per quarter cost of finance cost and depreciation. So, are we expecting 40 to 50 crore kind of EBITDA from subsidiaries this year? And what kind of margins we are expecting in remaining year in our subsidiary side?
Yeah. Thank you, Mr. Vikram. I think that's an important and interesting question. Yes, like what we mentioned in the AGM, the subsidiary will contribute positively, and your observation on the subsidiary performance for Q1 is correct. It had a loss, but generally, if you had observed the past history, the subsidiary's performance in the first half is always muted. It is likely to come back only in the second half of the year. And in the first half, our EBITDA margin for the subsidiary stood only at 5%. Our goal is to move that EBITDA margin by end of the year to about 7 to 8%. So overall, I think in the second half you will see significant improvement. The comment on the finance cost, yes, the finance costs, as you may know, have gone up compared to last year, but we were able to manage it, to a reasonable level. The interest costs have gone up, both domestic as well as international. But I think we are still around about 10% of the debt is our finance cost. So we should be able to manage that. So to answer your question, subsidiary performance will improve in the second half, and you will see for the full year. Thank you.
Okay. And sir, what was contribution of EMS business at standalone level in Q1? And are we expecting same kind of pattern as last year? We will deliver more of our strategic business unit in second half.
Yes, I think like what we have mentioned in the earnings presentation, you would find that EMS contributed to about 39% of the total. And it will continue to be so. And our BTS will perform better in the second half like last year. You're right.
Okay. And sir, recently in our Centum Day, we announced a 35 million order from electric mobility company and 10 million order of PIS. So what is execution period for these orders? And also I wanted to size of opportunity in India in PIS segment. What is order pipeline we have right now?
The question around electric mobility, yes, that can you just sort of repeat the question again?
Yeah, so recently we received 2 orders, one from one big electric mobility company and second order of PI, Passenger Information System, first order in India. So I wanted to understand execution period of orders, and also I wanted to know opportunity size of PIS in India and what kind of order pipeline we have right now.
Yeah. So with regard to the electric mobility business, I mean, the specific order we're talking about is executable over a 4 to 5 year period. But obviously this is not the only order that we are executing. We have multiple opportunities ongoing with multiple customers. So this is definitely an area that we have seen strong order intake over the past couple of years, and expect that to be an important growth driver for us. So that's on the electric mobility side. With regard to PIS, yes, this is a business that is also been with us through the subsidiary for some time. but we've been able to leverage the know-how developed there to be able to win the first contract in India. So there are significant opportunities there. Just to give a rough outline, our PIS business today is in the order of about 100 crores or so, and there's significant opportunity to grow there. I can't speak very specifically about our opportunity pipeline, but we feel there's some significant growth that we can achieve based on new investments in the sector.
I would just like to add, Mr. Vikram, instead of looking at a specific opportunity and the executable timeline, I would suggest if you look at the total order book of 1540 crores, each one of them, like for example, some of the BTS projects would be 2 years to 2.5 years, and EMS may be about 12 to 15 months, and ERT may be 8 to 12 months. So on an average, I would say that our order book is over 12 to 15 months. The entire 1542 crores is what I would say.
Okay. And sir, can you...
Sorry to interrupt, sir. I would request you to kindly rejoin the queue, sir. There are many other participants who are waiting for their turn. I would request you to kindly rejoin. Thank you, sir. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We'll take the next question from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Hello.
Mr. Gupta, may we request you to kindly use your handset, please?
Sure, I'm doing that. Am I audible?
Thank you. Please continue.
Yeah. On our, Airtel's Canadian subsidiary performance, I think, in this quarter also we have seen lower margins, and, that we had highlighted that the fixed price contracts there were leading to such, losses. So when are these contracts expected to get completed, and when can we, expect some, positive contribution from the Canadian subsidiary?
There are several steps that we're taking towards that. I think we do expect several of these contracts to be completed in this financial year, and we are, gradually cross-deploying some of the resources we have in Canada to other billable projects, so we can reduce the impact coming from there. Over the course of this year, we see this gradually improving. We're also doing some things to claim additional purchase orders from some of the customers to be able to compensate for some of these, but that's not completed yet, so we will await the result of that. And finally, we are also started to execute some of the work for those projects from India. We have built a design team also here. Manufacturing is already happening here. So with all of these, we expect that going into next year, we should see a positive contribution.
Sure. And, in your commentary, you have also highlighted that, there are several order book is in pipeline. And is this largely on the EMS side or the BTS side as well? That we expect that, we'll get some order fructification in coming 3 to 6 months.
Yes, both. The simple answer is both. We do expect good opportunities both on build to spec as well as EMS.
Sure. And on passenger information system on the BTS side, we are pretty bullish about the opportunities which are rising in the Indian markets. So if you can specify, what are our margins of PIS in line with the general margins that we have in BTS of around 20 to 25%. And secondly, since they won some orders from Delhi Metro, what will be the order size of the same, and over how many years is that executable?
So I think in terms of speaking about margin on the PIS business, I think it's important to break it up into two pieces. One is the actual gross margin on the product delivery side, and the second is the cost of development, people cost. So when we look at the gross margin itself on the product deliveries, we are somewhere around 50% or so gross margin there, which is a good number compared to what we would compare in a typical EMS kind of business. But the issue or the challenge that we've had, as I've mentioned earlier, is that we have resources in Canada which are high cost, and that has been pulling down the overall margin of that business. So this is where what we're doing is to move some of the work to India, and with that, we're looking at improving the overall margin of the business, right? So that was one of the questions.
The size and execution.
The size and execution, yes. So typically, the contract values can vary depending on the program itself, but a typical contract value can be anywhere from 5 to 10 million, or in some of the newer programs on mainline platforms can be even higher than that. And these are typically executable over a 3 to 4 year horizon.
So the Delhi Metro contract that we have won recently that we spoke about in the AGM also, how big is that order, and what kind of margins do we expect in those kind of orders, when, especially where we'll be executing the projects from our from our standalone operations?
Once again, as Desikan mentioned, we don't want to go into very specific order-related points, but as I mentioned, this is typical contract that we've received, and it's, we see somewhere in the $5 to $10 million range and executable over a 3 to 4 year period.
And any other projects in pipeline that we have bidded on PIS amongst Indian metro authorities?
Yes, there are. There are other projects we are bidding on. In fact, we are working very closely with one of our main customers, which is a global OEM, to essentially be a platform supplier for PIS systems. So that would essentially mean that it can be for any metro in different parts of the world. A certain share of their business volume will be awarded to us. So that's something that we're in the progress of working on. So it's not only Indian projects, as I mentioned earlier. We are working on even global programs.
Sure. Just last question on the Chandrayaan-3 mission.
I'm sorry to interrupt, sir.
Sure. Okay, I'll come back.
Thank you, sir. We'll take the next question from the line of Amar from Alpha Accurate. Please go ahead. Mr. Amar, I have unmuted your line. As the current participant is not answering, we'll move on to the next question, which is from the line of Chirag Kacharia from Ashika Institutional Equities. Please go ahead.
I have a couple of questions to Desikan and Nikhilji. What will be the effective taxes for FY24 and the future years? Second, on ER&D side, as we are moving operations from Canada to India, what is the directional call over there, and when we see the complete or approximate higher transition from Canada to India in quarter period wise?
So I guess the first question was on the effective tax rate.
Yeah.
So that will be at the standalone level will be at 25%. And on the transition from Canada to India, it is started and it is gaining progress. We expect this to happen by end of this financial year, so that subsequent projects can be executed from India.
Okay. And on onshore offshore mix side, what blending we are expecting?
Onshore-offshore mix is a bit of a longer thing. We right now a lot of our engineers are either on site or working on programs in France. So this is I would say probably a 2-year to 3-year ongoing journey that we're on, and it will be a gradual shift in terms of the mix that we have.
Okay, all the best. Thank you.
Thank you.
Thank you. We'll take the next question from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
Hi, Nikhil. So my first question is on the growth in EMS, which we have witnessed. In your initial remarks, you highlighted that it was a result of few new customer ramp-ups. If you can add more light to what were these projects or, the nature of these customer wins, is my first question.
Sure. So I think a couple of things there that we see. We essentially to be able to better utilize the capacities that we've put up a couple of years ago, maybe 2-3 years ago, we were focusing on segments where it is still high technology, long cycle kind of businesses, but have higher volumes. So we chose industrial and electric mobility as some of the electric mobility and clean tech, broadly speaking, as some of the key focus areas for us. So those were customers that we had added. So we have, and all of them are global OEMs that we are referring to here. So just just to highlight some of the application areas, there's obviously electric vehicles itself, where we're doing electronics for the powertrains. That's been one. The other one was on clean tech, where we have a customer. We're building electronics for the hydrogen fuel cell area. That was another customer that we've been in ramp up on. And another customer which is making equipment for power grids. This is also a result of Make in India push, and now we are actually supplying to their global demand from India. And we are a single source supplier essentially on these product lines that we're working with them on. So this is just a flavor of some of the areas. But in addition to this, our legacy defense customers also, they have come back quite strong. The result of the Ukraine war, as well as increased defense budgets in Europe, have helped us to take higher orders from them in the past year, which we are now in the execution phase for. This is typically our offset kind of customers that we're talking about. So.
Got it. Great. My next question is that on the vision of improving our EBITDA margins for the subsidiary 3-4 years hence, would that be a function of only cost, or do you see scale playing out a major role in improvement of that EBITDA margins going ahead as well?
Yeah. So you're right. It's a roadmap type of a thing, I would say. Presently, we are in the range of 5 to 7% in the subsidiary, in the EBITDA margin. Obviously, the focus is also on cost reductions, which we have initiated both in France as well as in Canada. Like what we mentioned earlier, Canada, we are trying to get the manufacturing transferred to India and keep the cost as low as possible. That's the immediate low-hanging fruit. The second one would be the onshore-offshore, which presently is not fully leveraged, though we are increasing the headcount here. If you ask me, the onshore-offshore will be in the range of 10 to 15% only on the offshore. So we need to bring more business into the Indian design center and thereby improve the profitability at the French subsidiary. That's the second one. And the third one is the immediate focus is at the French company level itself, we need to move the EBITDA to at least about 10%, because that's an average French company EBITDA margin, I would say. But with the strength of the Indian entity and the technical knowledge of the French entity, we are bidding on bigger projects which can be awarded to the French entity, and that would probably be, partly done in India, and thereby it will move from the 10% to a higher EBITDA margin. It may not be exactly like the Indian guide, but it will definitely be in that direction. Those are the three things that I would say. One is cost reduction, two is onshore, offshore, and three is bidding for bigger projects with this on the strength of the Indian presence.
Just to add, I think point being simply that even without scale, we feel we should be able to improve the margin up to a 10-11% range. And beyond that, I think there will be a contribution both from scale as well as from the onshore-offshore mix.
Great. Thank you for the answer. My final question is on the execution rate. On the order book, it has been in the range of 65 to 80% in the past. Would you want to guide any number as to how you are looking at the execution rate for FY24?
No, I think I mentioned earlier also, because the different businesses run at different speeds, the existing order book of 1,540 crores, you can take it like 12 to 15 months of execution on an average.
Great, thanks. That's it from my end. Thank you for the answer.
Thank you. We'll take the next question from the line of Amar from Alpha Accurate. Please go ahead.
Yeah. So thanks a lot for the opportunity. Couple of questions. Firstly, sir, if you can give us the breakup of the order book in terms of, let's say, engineering, R&D, EMS, and build to specification.
Yeah, so it's roughly in line with our revenue share that you'll see there. So you can say about 30 to 32% on the ER&D side, about 38 to 40% or so on the EMS side, and about 28% or so on build to spec. So it's roughly in line with our revenues.
Okay. And sir, you said that electronic execution period, EMS execution period is 14 to 15 months, build to specification is 2 years, and ER&D would be how much? Execution period of the order book?
Between 8 to 10 months.
8 to 10 months, okay.
8 to 12 months is anything, actually, yeah.
Okay, and this bulk of your, basically, the French contribution would be coming into ER&D space, right, currently? The French and Canadian business?
Yes.
Okay. So that is where basically
the part of the business, there will be a contribution in the build to spec part, the PIS part, but as you said, majority of it is in the ER&D space.
Okay, but some bit in the build to specification also.
Right.
Okay. So basically that is where the bigger change will happen because of the offshore mix as well as the bulk of the business coming from Canada to India.
Yes, and basically stopping the budget overrun, as you mentioned.
And sir, this transition which we are talking about, will that transition will be visible from, let's say, Q2, Q3 onwards, or it will be more back-ended than the front-ended?
It will be more in Q3, Q4. That is you can say a natural seasonality that we do have in the business, but also as a result of some of these actions that we're taking.
Okay. And at a closing basis, let's say a run rate perspective I'm asking about, at a closing level, do we expect to close the, let's say, overall EBITDA margin or engineering R&D margin to, let's say, 7-8%? Closing basis?
Yes, definitely. Yeah.
Perfect. Thanks a lot, sir. I'll come back in case.
Thank you. We'll take the next question from the line of Ankit Babel from Shubham Ventures. Please go ahead.
Good afternoon, sir. A couple of questions. So what were your order inflows in Q1 at consolidated level, and what kind of order inflows you are expecting for the full year at consolidated level, excluding any customer forecasts?
Order inflow in the Q1 was roughly equivalent to the revenue that we did, because you would find that order book is more or less flat.
Yeah.
So that's one. But of course, we do expect the order inflow to increase significantly. But that we will probably, as we go along, we'll tell you.
Okay, but can it be like 1,500 to 2,000 crores? Because anyways, you'll be doing a revenue of more than 1,000 crores.
Should
for
be.
growth.
Yeah, we basically, as we mentioned, our medium-term objective is to be at 20% or so overall. So we do see our order book also increasing at that, if not better, rate.
Sorry, you mentioned that you expect to grow at 30% for the company as a whole.
No.
Sorry, I didn't get your word.
20% is what he said.
Okay. And sir, you mentioned that the margins in the subsidiary business would be around 7 to 8% for the full year, FY24, right?
Yes.
So does it include the Canada subsidiary also?
Yes.
Okay, then what will be your margins in the standalone business for the year as a whole?
We should be going back to our 12 to 13% in the standalone EBITDA.
Okay, so it is fair to assume that for the full year at consolidated level, around 10-11% EBITDA margin is possible.
Yes.
And what is the way forward, sir? Say in the next couple of years, 2-3 years, 2 years. Let's talk about 2 years.
No, our objective is basically to move towards the 13 to 15% level at a consolidated basis. So
correct.
That's our objective really on a 2 to 3 year kind of basis. It will obviously depend on the mix that we have going forward, but based on our visibility, that's what we're working towards.
Okay, that's it from my side. Thank you, sir.
Thank you.
Thank you. We'll take the next question from the line of Karan Sanwal from Niveshai. Please go ahead.
Hello, am I audible?
Yes, sir. Your voice is a little muffled. May we request you to use your handset, please?
Yeah, am I audible right now?
Yes, sir. Please continue.
Yeah, so wanted to understand that our employee cost remains almost similar at a console level year on year. So the employee cost as a percentage of sales reduces maybe the quarter end or maybe quarter 4. So will the trend be similar going forward, or could we expect a reduction in employee cost as a percentage of sales?
Your question is employee cost as a percentage to the revenue, or?
Yes.
Yeah, it will remain the same.
On a year-on-year basis, right?
Annual basis, yes.
Right, understood. And you were talking about reducing our headcounts in the Canadian subsidiaries. So if you could provide us with a number that we have actually how much reduction that has already been done, and also if we are obligated to pay any severance pay to those employees going forward.
The team size we have today is at around about 38 people or so in Canada. This has already been reduced from a higher level about a year ago that we had. In terms of and the second part, in terms of any severance pay, we have not had any impact on that. This is all as a result of basically natural attrition that we've had.
Okay, and the last question is if you could provide the receivable and inventory levels for Q1 FY24, the numbers.
It remained at more or less the same levels like March 23, which is inventory is at about 105 days, and receivable is about 110 days or so.
Okay. That would be it. Thank you.
Thank you. We'll take the next question from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, Nikhil. So my first question is on BTP side. If I think in our earlier interactions, the indication was that, this segment typically does around 8 to 9% EBITDA margin. But I think in the AGM we said that we'll move towards 12-13% kind of a number. So can you give us some thoughts on what has changed? Is the type of orders that we are getting is different, or it's the scale advantage which is playing out? Some thoughts on that.
Yeah, it used to be, you're right, it used to be historically around 8 to 9%. We did a couple of things. Number one, we went ahead with the new customers in this, what Nikhil mentioned, the electric mobility, clean tech, and more of industrial electronics. So we moved towards more of mid-size volumes and medium mix than, high mix and low volume, which was typically the defense side of it. So the reason one, a shift towards increasing the industrial electronics with medium volume and medium mix. That was number one. And number two, also because the high mix involved a lot of costs, both in terms of manpower and processing costs, the shift to this actually already brought down a little bit of manpower cost. So in terms of number of people for the same, higher revenue remained the same. That was number two. And number three, and the Industry 4.0, we have initiated inside the factory. And due to that, there's a lot of process improvements, including automation, digitization, all of that, which helped us to control the cost. That's one. And finally, we could get a better margin from the customers in the newer sectors. So this combined effect of all of this is what drove the EBITDA margin from 8 to 9% to more than 10%, 11% also.
Okay. Sorry.
Go ahead.
Yeah. So essentially, in the mix, the order mix and the revenue mix, the proportion of offset would be how much, and how do you see that going forward?
Can you repeat that question, please?
The proportion from the offset business, which was typically a low margin business on the defense side, is that proportion, what is it currently, and how do you see that going forward?
Overall view is that it should remain relatively flat. Just to be clear, when we say offset business, this is part of the EMS business. Whereas when we talk about the build-to-spec defense stuff, that is on the build-to-spec side. So with regard to offset for defense, we expect that to remain relatively flat, and it represents probably around somewhere between 15 to 20% of our overall sales.
Okay, got it. My second question is on the overall numbers that we're talking about, around 20% revenue growth. So I assume that ER&D business is low single-digit growth, considering that our focus currently is to bring back the profitability. So that means that the other two businesses have to grow at more than 25%. So one, in terms of order book on the BTS side, what gives us confidence that BTS will be able to grow at 25%? And also on the BTS side, if you can give some sense as to out of the total BTS order book, what is the developmental orders, as a proportion of the overall order book?
Yeah. On the build-to-spec side, these typically are projects that have been in the works for quite a long time. From the time you actually start going after an opportunity till the time you actually receive the order can be, 2 to 3 years sometimes. So, our confidence is based on the fact that we've been working on some specific opportunities for quite some time. We were actually hoping to receive some orders in the current quarter, or in the last quarter, but they were delayed. But we still feel fairly confident that we should be able to win those contracts. There are also some others which are L1 based, so that we have to wait and see how it comes out. But with the limited competition in the mix. Then, with regard to your question on development orders, I would say a big portion of these are development orders. So they will require design effort followed by production. There are few things we are working on in the armored vehicle side, which Deshkan touched on in his earlier remarks, where that will be production-based orders. There we have invested ourselves on developing indigenous equivalent of imported products, and once they are qualified, some they are qualified already and got the first few orders. Those will be production or annuity kind of business. So it's a mix, but I would say this year's projection, majority of the orders we're expecting will be development orders.
Okay. Just to follow up on that, so a developmental order, let's say you do that developmental order and execute for 2 years and it's done. Then typically when those products are commercialized, the revenue potential from those products is multiple times of your developmental order. Is that a right understanding?
It depends on the application. So if you're talking about applications like radar or for aircrafts, Navy, land systems, all of that, you're right, absolutely. Those will be the recurring orders will be higher. But we also sometimes have, especially on the space side, which has been a strong area for us, those are typically project-based orders. So you win an order to develop and supply electronics for payload for a satellite. And there are times where those same satellite constellations may be repeated subsequently, or they may require some sort of further modification in the subsequent orders. So I hope that answers your question.
Yeah.
Just to add, the question is right. In defense, before even accepting a development order, we look at the potential possible at the end of this development. So, unless the potential is sizable, we may not even embark on the developmental order. Whereas in the space sector, it may be like what Nikhil said, it may repeat, but it may repeat after 3 years or 5 years, because the same satellite doesn't go every year. Okay. So that's the point.
Right. Yeah, got it. Very useful. Thanks a lot. That's it.
Yes, Mr. Michelle? Hello?
Excuse me, sir, can you hear me now?
Yes.
We'll take the next question from the line of Narendra, an individual investor. Kindly proceed.
Yeah, thanks for the opportunity.
one question regarding the import ban that the government has imposed on certain electronics. So does it help us in any way, or it does not pertain to any of our segments?
If you are referring to the ban on the import of laptops and computers, it doesn't affect us because we are not in that business at this point of time.
Okay. Are we planning to?
No, as a strategy, we have been on the high-end and high-tech of electronics. We have not considered consumer and telephone, mobiles, etc. So, not at this point of time. We don't have plans.
Okay. So, and also regarding your 20% growth target, so I'm assuming it's for FY2024, right?
Sure, yeah.
So what could be the, say, medium to long-term target that you are planning to do?
Yeah, actually, I mean, what we talked about was really a 2 to 3 year kind of CAGR we talked about. We don't give very specific guidance on a year-on-year basis. But, we feel reasonably confident we'll be able to achieve that level of growth on a at least a 2 to 3 year basis.
Okay, and on the margin terms, say 5 years down the line or 4 years down the line, how much are we expecting to do on that front, given the scale and the cost saving measures that you are taking?
4 years out is a long time. So, like we said, based on our existing business mix and visibility that we have, we're working towards a 13 to 15% target in over 2 to 3 year kind of horizon. Beyond that, I think it will largely be based on the mix. Fundamentally, each of these businesses have an associated margin profile with it. So, where it can move after that will be largely dependent on how the mix will go. So, on the build-to-spec side, if we see some very, very significant project wins, you may see an improvement further from there. But fundamentally, it's a bit early to say anything about 4 years out.
Okay, so could you throw some light on the margin profile of the different businesses? Like, what are we doing on each of the business segments? If you could share, it would be helpful.
Yeah, so as I mentioned at the beginning, if you talk about the EMS side of the business, this is fundamentally build-to-print kind of business. So that's where we manufacture subsystems or systems for global OEMs. So this can be for defense kind of customers and offset, where we're making electronics for the Rafale jet, air traffic management systems, and so on. Also on the industrial side, we make electronics for industrial power plants or power grid infrastructure and so on. EVs has been another area that we've been building out, and also some medical devices, right? So these are areas on the EMS side. On the build-to-spec, we have, for example, payloads for satellites. We make subsystems on missiles, armored vehicles, so on. Or guidance system, for example, on missiles. These are some of the examples that we do. And also on the transportation side, we make the passenger information systems inside the trains. And finally, on the engineering services side, we work with, again, multiple different sectors and customers. So we work on avionics, for aerospace. We work on, different types of control electronics for defense, or signaling kind of equipment for railways. So, these are just some examples of the kind of things we do for these sectors.
Okay, thank you. All the best.
Thank you. We'll take the next question from the line of Pranav Bastawala, an individual investor. Please go ahead.
Yeah, thank you for the opportunity. I've got only one question. See, electronic manufacturing industry is going at an exponential pace, and next 10 years looks very exciting. Now, as Centum is also likely to grow at 20%, that is what I am been hearing. But when we look at the EMS industry as a whole, it is going to grow by leaps and bounds, and that's the kind of the opportunity we have. So what are the growth levers for this company? Mr. Desikan or Mr. Nikhil, you can spell out how we are going to grow. What are the other areas by which we can grow beyond 20%, and how exciting those opportunities are? Can you shed some light on that? Yeah, thank you.
Yeah. So I think the first thing, Mr. Bastawala, I think is that we, as a company, we are not exclusively EMS. So while we see a very aggressive growth in the EMS division itself, when we say 20% overall, it is including all the other divisions of the group as well, right? So just to say that we do expect some aggressive or more aggressive growth plans in the EMS space itself in the coming future. So in terms of what we are working on, essentially, a couple of the decisions I talked about earlier was to move more aggressively into the automotive space, which has historically not been an area that we were present in. But we made that decision already a couple of years ago, and we've seen the benefit of that in terms of new order intake over the past year. So that we expect will be an important growth driver for us. In addition to that, industrials and clean tech has been another area that we've seen very positive traction on. And that's driven either by the fact that the Indian government itself has put various restrictions in terms of, when it's buying for government-based tenders and so on, where it mandates that certain amount of or certain indigenous content has to be present in the equipment that they buy. That's been one. Or on the second, we've also seen some large U.S. companies, for example, looking to move out of China, and they've identified us as a potential candidate for this shift. So these are some of the real instances that we are seeing, which are substantial opportunities, and we hope to capitalize them in the coming next.
Sorry, if I can squeeze one more question. Is it possible?
Sure.
Yeah. So in space radar, we have tied up with Indra. So apart from that, are we in a position, or are we looking at some other possibilities also with Indra? Because this is going to be one more division which is going to give a very huge revenue to this organization, and it can scale up considerably. Can you just throw some light onto this?
Yeah. So I mean, I wouldn't answer basically specific to Indra. I think the point being just that we are looking to move up the value chain to deliver full systems to the armed forces. And, there's different areas. We had space radars we talked about, but we've also done some partnerships on the electronic warfare side, and on a few other things. So we are working on some significant opportunities beyond the space radar to be able to position ourselves as a supplier of systems directly to the armed forces.
Yeah. Thank you very much. Thank you very much.
Thank you. We'll take the next question from the line of Vinay Kumar Jain, an individual investor. Please go ahead.
Thank you. Thank you for the opportunity. I just wanted to ask, while other players in the EMS industries are giving a growth projection of 40 to 50%, why is Centum sticking to 20% growth target only?
Yeah. So as I mentioned earlier, we first of all, we are not only an EMS company, as we share with 40% of our overall number is EMS. So when we speak about overall growth rates, it's at a consolidated basis, including the other segments. Having said that, we obviously have aggressive internal targets that we are working towards. But based on the visibility that we have, this is a medium-term thing. We feel confident at a minimum to be able to achieve. But as I said, we are working towards more aggressive targets.
Thank you. A second question. Since we are in the space segment for such a long time and associated with ISRO and participated in very important projects like Mangalyaan, Chandrayaan, so are you looking at getting some business from NASA and SpaceX also?
No, NASA is not really a major opportunity that we see currently. The space sector also tends largely to be parochial or nationalistic, so to speak. So they would be obviously promoting American companies in terms of their own contracts. So our focus in terms of space continues to be on the Indian market. But there are certain things that we are doing to be part of global programs with the global OEMs, like Thales Alenia Space or others which are existing customers for us, where there are some opportunities which are coming up for a company like us to be part of the program.
Okay. Thank you so much. Thank you.
Thank you. We'll take the next question from the line of Jay Jasrani from Mountain Lion Partners. Please go ahead.
Good afternoon, everyone. Thank you for the opportunity. Wanted to know that the French subsidiary has been invested like 5 to 6 years old. There has been a good turnaround in terms of trying to get business from there to India and trying to improve margins. But since the time it was invested, was the growth expectation to be this low, or are we looking at a faster growth from the French subsidiary than what it is currently? And do you see it growing faster than the Indian subsidiary? Because the French subsidiary is more towards targeting to the world opportunity, and India opportunity is growing. But do you see the France giving us better growth in next 2 years? I don't want to look ahead, just in next 2 years, because it's been the 7 to 8 years that we would have invested in the company. Thank you.
Mr. Jasrani, thanks for the question. I think if you look back at the history, there's obviously been multiple impacts that we've had since we entered the company. We talked about already the divesting of a substantial part of the business, which was the energy products division that was divested a couple of years ago. So that was one of the impacts, and then subsequently in the post-COVID period, we also had an impact because of the industries that we operate in. So that's been some of the challenges why we're not able to see the growth over the past few years. Having said that, I think this year, first of all, we do expect a reasonable growth coming from the French subsidiary itself. And to the question of what we're looking out in terms of 2 years, our first objective with regard to the subsidiary is more to improve our margins by optimizing on the costs and the execution. And that's really the first focus, rather than pushing for very, very significant growth happening from there. So, and I think, in terms of demand purely from the engineering services side itself, the important point is we do have very good customers, and we are in good spaces. So I think once we are able to work out our fixed so to speak, on the margin side, then we should be able to drive growth after that.
Okay. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management from Centum Electronics Limited for closing comments. Over to you.
Okay. So thank you all for participating in this earnings call. I hope we were able to answer your questions satisfactorily and at the same time offer insights into our business. If you have any further questions or would like to know more about the company, please reach out to our Investor Relations Manager at Valorum Advisors. Thank you, stay safe and stay healthy.
I wish you all a happy Independence Day tomorrow.
Happy Independence Day.
Thank you.
Thank you very much, members of the management. Ladies and gentlemen, on behalf of Centum Electronics Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.